Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thank you for joining us here where we take deep dives into specific topics around your financial plan or your financial well-being. And this week we're going to be talking about the very exciting topic of life insurance. Now, we're going to dive into some of the different types. We're going to dive into when you might not want to use those different types of insurances. It's not going to be a complete picture. Life insurance actually is a very, very critical part of a financial plan, at least to be examined and to be explored. You may or may not wish to make that investment or to use that strategy, dependent on the pros and cons for your specific situation. So as always, what we're going to cover here is just for information purposes. Don't take it as advice. Don't take it as solicitation. Do go to your professional financial planner to help you choose what might be appropriate for you or how you might apply it in your situation, or contact us. As always, go to mikeonmoney.com where you can contact us, book an appointment, give us a call. Happy to look at your situation, how you might use it, especially business owners. There's a lot of great tax advantages to using certain types of insurance policies to benefit not just your financial plan, but your tax strategies. And on the individual basis, of course, we're going to explore some of those estate plans that you might want to use insurance. So I know it's an exciting topic. Don't turn off watching yet. You might learn a little bit. I'll try to make it as interesting as possible and we'll get through it. As you can see, we're still working from home part-time. We are in the office part-time these days on a limited basis, but I'm filming our deep dive videos from home still. So sorry for the kind of casual work background, but we're here to help you. All right, so let's dive into insurances. So let's break it down, first of all, to types of life insurance. So there's basically two different types. They all have different features. Different policies might have different features, but they can be broken down into two different structures. One is term insurance, sometimes called temporary insurance, and the other being permanent insurance, which by its name is for more permanent, longer-term risks. And keep in mind, life insurance is just that. It's just like car insurance. It's just like house insurance or liability insurance. It's to offset a risk you have either in your plan or in your life that you want to protect against something happening. In this case, obviously, that something happening is your death, and then following that, of course, your income or your inability then to provide income to pay for things or to cover off that risk that you're trying to protect against. So let's start with the easy ones, the temporary or term insurances. So term insurance typically are 10-year term, 20-year term. They can be called T100 or to term age 100 as well. Those are used a little bit less because they lack a cash account feature that you would find in a permanent insurance. But they can be used, and we'll touch on that. But the 10 and 20 are probably your two most common, and they're there to offset a risk that exists temporarily. So, either in those cases, 10 or 20 years. Now, remember, all insurances are unilateral contracts, means once you initiate them, they're in your control. They can't be canceled on you. They can't be changed on you. You can make changes to them or you can cancel them. So you're not bound to them. So if you take a 20-year term and whatever risk you're trying to offset, it doesn't exist after 15, you can just cancel it at the end of the 15. So you're not bound to have it for the full term, but they're bound to provide it to you for the full term. So as their name indicates, if you take a 20-year term policy, at the end of that 20-year term, your insurance coverage technically ends. It doesn't actually. I'd say almost all term policies have an auto renew feature, meaning that they will roll over into another 20-year term at a higher cost. The cost is, you find out the cost before you start the term. There's a renewal rate usually listed inside your policy. It's a much higher cost than your original cost because now you're older, of course. So most people at the end of the 20-year term, if they still needed the policy, they would go shopping for a new policy to see if they qualify health-wise for a cheaper a 20-year term than that auto renew number would be. You might want to keep it if your health isn't well and you wouldn't qualify for a new policy. you might want to keep that auto renewal and let it roll over and pay the higher premium. It might be worth it to keep that protection in place. But at the end of the 20 years, you have the right, or at any point you have the right, but at the end of the 20 years, if your risk no longer exists, you can cancel that off and stop paying the premiums. There's no cash values, there's no cash back to you. You only paid for the insurance coverage during that time. And it's a lot cheaper. Term policies are a lot cheaper because they're temporary based, and because you're not adding any other features or long-term savings to it. All you're doing is paying that risk cost. So they're generally used, as I said, a temporary risk. Mortgage insurance would be an example. You can get mortgage insurance automatically through your banks on the mortgage. We don't recommend those generally. There's a few features that aren't beneficial to you, and they can be higher priced. They're called, they're annual renewable. Basically, the cost goes up every year you get older. So term generally is a cheaper alternative, and your payouts can be higher because, of course, as you pay down your mortgage, but your insurance payout stays the same, so there could be left over to your estate or to your beneficiaries beyond paying off the mortgage. So if you take a 20-year amortized mortgage, a 20-year term policy is perfect. At the end of the 20 years, the mortgage is paid off. You no longer have a risk to offset. You can cancel that. You can cancel or close that policy off. No need for that insurance anymore. Another one is kids. So a lot of people, I recommend a lot of new parents that taking out a 20-year term policy, even if it's to enhance a permanent policy, but taking an extra amount of insurance for that first 20 years of your child's life. So those years where you're more financially responsible for them. I like to say you're not financially responsible after 20 years, but as a parent that's got a 19 and a 17-year-old, I'm quickly realizing I'm still going to be responsible for them for a while. But your major investment, right? Raising them, feeding them, providing shelter, paying for school, all that in that first 20 years is the highest risk. So you get an extra 20-year term policy. It's not that expensive. We're certainly not compared to the permanent policies. And at the end of the 20 years, they might still be living in the house. They might still be feeding them, but those major costs have been offset. And now if something happens, they might be well on their way to be on their own, or at least you've covered off as much as you could to get them ready to go and move out and start their own financial future in their own life. So if something should happen to you during those years, that extra insurance, that extra coverage would pay to make sure they're provided with housing, lifestyle, schooling that you wanted to provide for them when you were alive. So you can use that term insurance to cover that. So those are a couple of examples of temporary insurance. You might also want to use temporary insurances for business uses, maybe a key man insurance. So that's, if there's one person in a company that if something happened to them, it would drastically affect the company's earnings or ability to earn. You might want to insure that person, for the length of their potential career or their tenure there. And, if something does happen to them, unfortunately, at least the company would receive that payout from the insurance policy to offset it. Also, partners insurance, often used when there's a partnership. You can put the insurance in place, and basically if one of the partner dies, the other partner's family automatically gets bought out by the insurance. So the surviving partner is not left with the burden of having to come up with money to buy out the partner, or bring in another partner that might not be favorable or fit within the plan or within the company. So partners and key person insurance are both very popular. Where term, sometimes permanent, but term can be used as well. So those are the term insurances. They're very powerful. As I said, the most cost-effective ways to offset those risks. The other side, permanent insurance, as it indicates in its name, is designed to last permanently, so for your whole life. So it's not something you really want to cancel over time. They're more expensive. They're more expensive because they carry a cash account or a cash surrender value. So in the premiums that you're paying every month, part of that is going to that cost of insurance. So the cost of keeping that protection in place. The other part of it is going into the savings account that's inside the policy. So people often will use these for a myriad of different reasons. One, they are cheaper over a lifetime, as opposed to renewing term insurance through your lifetime. And a lot of term insurances, actually, a lot of policies won't renew after age 75 or 85, depending on which insurance company you're with. But a permanent policy, of course, goes your entire life or until you decease. And that savings account can be used for a lot of different factors. So one key feature of that, a savings account, it is tax sheltered, just like an RSP. Any money that goes in there, you don't get a deduction to put it in there, but any growth on there is tax deferred, and it can grow. And you can invest those those cash accounts, really dependent on which issuer you're with and what type of permanent policy you take, depending on how many or how broad your investment options are. Some are very broad and you can invest in almost any of them. Some are more limited. It depends what you're looking for when you buy the policy, as to what options that will be made available to you. So it's a good question to ask, depending on what you're trying to achieve there. So you can have growth in there. You can invest it just like you'd invest in RSP, and it continue to grow. And you can use that cash account for a lot of things down the road. Well, one, you can withdraw from it. It is a taxable event to some extent. Again, that calculation will depend on how long you've had the policy, how much you've put into the policy, how much growth has happened in that policy. So you'd have to really look at that, a benefit or non-benefit of taking that money out in the long run. But you can withdraw from it. The other thing you can do is you can build up that cash account. So you can put extra money into that. Again, the amount extra you can put in depends on a lot of different factors, age, how long the policy's been in force, et cetera, et cetera. Those calculations are easy for us to get, but it's unique to kind of each situation. But you can put extra money in there, so you can have extra money tax sheltered, which can be a good benefit. And what a lot of people do there is they'll accelerate their payments so that it becomes what we call a paid up policy. And what that means is you've accumulated enough and you've grown the money enough inside that savings account that it's now paying the insurance premium. So the growth of the cash value is enough to pay the cost of the insurance. So now you no longer have to make any payments. And you can tailor make those. You can say, I don't want to pay for 15 years, I want to pay for 20 years, I want to pay for 10 years. Obviously you're making higher payments during that period of time, but at the end of that time, if you structure it correctly, and do make sure, because it all gears on the rate of return that you're getting in there. And sometimes they overpromise, and if you don't achieve that rate of return, then you have to keep paying for a longer period of time. So do be very careful about the model that they use to predict your paid up date. There are ways to get guarantees around that, but you have to look into those features when you get the policy. But if you have a paid up policy at the end of your paid up period, now it pays for itself. You never have to worry about it. The insurance will stay in place for the rest of your life, and it will pay out to your beneficiaries when you pass on. So why would you want a permanent policy? Well, as I said at the beginning, I'm going to park to the side here the tax strategies you can use around permanent policies. There's quite a few. If you're a business owner, there's even more. If you're an individual, there's a lot of different ways you can create tax deductions for you while you're alive, while you're using that policy that you might want to implement. But I'm not going to dive into that. That's a whole other topic, and it would take twice as long as this video to go through it. I have talked a little bit about it in our estate planning videos. You can go check those out. But do reach out to us at mikeonmoney.com if you have specific questions around the tax benefits of those permanent policies. But for now, let's just talk about kind of the insurance aspect and that cash account aspect. So the cash account, as I mentioned, you can have it paid up. Permanent policies are great for things that you need permanent. You're just trying to offset permanent risk. So one of the most common ones is an estate creation. So let's say you've saved up, you're retired, and you just want to spend all your money on yourself, enjoying your retirement and doing what you want to do. But you do still want to leave money to your beneficiaries or the next generation, or maybe the next generation. You can get a permanent policy, put it in place, and when you die, it doesn't matter how much money you have left in your savings or in your estate, the insurance will automatically pay to those beneficiaries tax-free. Remember, all Canadian life insurance policies do pay out tax-free. Would automatically pay down to them outside of probate, outside of the estate, a predetermined amount, whatever amount you wanted to make sure that they had, for their futures or to help them out by creating a estate. You might want to equalize an estate. We see this often where maybe along the way you helped out one child, who might have been struggling, or the situation dictated it. Maybe you gave one child a family home or a cottage along the way, and really help them out. So when you pass, you want to make sure that maybe you have one or two, other beneficiaries that you want to. I want to, even things up at one point. So you can have, let's say you gave someone a cottage or a recreational property that was worth $500,000. You can take out a life insurance policy, make the other child the beneficiary of that upon your death, they get $500,000. So it even things out in the long run. So estate equalization is another very common tool that you might want to use it for. Along those same lines as the recreational property, you might own a recreational property that the family has used, maybe multiple generations have been using. You have multiple beneficiaries. Maybe there's not an agreement on who would pay the taxes upon your death, because of course secondary properties do have capital gains due upon your death, or who's going to pay. Maybe there's a mortgage on that property, so maybe just transferring it down is not feasible for that next generation to take it over and pay those costs. They might say, no, let's sell it, pay all the costs, and then we don't have to worry about it. But if you wanted to keep that, maybe you want to leave that as part of your legacy, you can have an insurance policy in place to pay those taxes and expenses when you're gone. So now they get it basically unencumbered, and all they have to do is maintain it, and maybe that's acceptable for them because they really want to keep it and keep it in the family as well. So that's one way to make sure that your legacy or that property stays in the family through the generations. Or it could be any other tax liability that you just want to offset for your heirs. You don't want them to be encumbered or have to pay the taxes. You just want to make sure that there's money there to make sure that all those expenses are paid. So that's where a permanent policy would come into play in estate planner. Now there's a lot of other different reasons you might want to have one. Again, I'm not going to dive into them all. Just want to give you an idea of where permanent and temporary would sit on the scale. Again, happy to go through your specific situation to make sure we look at how it can benefit you, how you can keep those costs down, or take advantage of potentially some of those tax strategies you might have or you might be able to use to reduce your tax liability every year using an insurance policy. Now, whenever you're looking at your financial plan and you're looking at an insurance as a possible strategy, that's what it is. It's a possible strategy. It does not mean you necessarily require it. You have the option to implement it. You can decide, I don't want to offset that risk. I'm going to accept that risk. So a lot of times, people are afraid to look at insurances because they're, one, it's a bad topic, talking about your death. You're talking about the estate. It has this air of, I'm going to be sold insurance. I don't think you should look at it that way. I think you should explore it, see what the costs are, see what the benefits versus the pros and cons are, and then assess whether you want to offset those risks with that cost or not. Decide how it impacts things one way or another. Another thing I wanted to just mention quickly for permanent insurances, if you have a pension at work, you know that one day you're going to be faced with the decision of what type of pension to take. There's all different kinds of pension. One of them is 100% payout to my spouse. So if something happens to you, your spouse continues to receive that pension at 100%. Or the spouse doesn't get the pension if you die, so you take single life, meaning it only pays until you die. And sometimes they have 10-year guarantees. We'll avoid that conversation right now, but basically it only pays out for your lifetime and then it stops and your spouse doesn't receive it. Well, the difference between those two payments is basically insurance. What you can do is take the single life option, but go buy a permanent policy that would pay your spouse out an equal amount of money that would allow them to continue to receive an income equal or at least sufficient for them beyond your death, and not have to take that reduced pension for the spousal rollover. So it's called pension maximization. We have to crunch the numbers before you make that option. Do not take that option until you figure out the cost of the insurance. It doesn't make sense. Some cases it does, some cases it doesn't. It's really worth doing the exercise. It's pretty easy to do the calculation and say, in this situation, which pension option should I take? Which is going to put the most in your pocket and your spouse's pocket in the long run and protect against that risk. So that's something else to keep in mind. So with that, I'm going to wrap it up. I know this dive was a little bit longer. As you can see, it's just a flow chart of different options when it comes to insurances. But don't be afraid to talk about it. It is something to consider. You might want to park it and not implement it, but do know the pros and cons and the costs for your particular situation before you take that risk on without fully kind of quantifying it. So with that, I'll say goodbye. As always, reach us at mikeonmoney.com. Send us in your comments or any topics that you would like to hear us talk about. Reach out to us if you have any questions, and I can't wait to talk to you guys again next week. Thanks again. Bye-bye.